Good afternoon, everyone. Welcome to the launch of the 2026 WTO Global Trade Outlook and Statistics. I'm Ismail Ejeng. I'm the Director of Information and External Relations here at the WTO. The report and press release are available already on our new media newsroom. And just a quick reminder, the report and everything that is said in this press conference are under embargo until 3 p.m. Geneva time. We also have interpretation available in English, French, and Spanish. We are joined by the Director General, Dr. Ngozi Okonjo-Iweala, and our Chief Economist, Robert Staiger. We'll start also on the podium. We have the economists who contributed to this report. To my right, Thomas Verbit, who is the Chief of the Integrated Database Unit. To Bob's left, we have Coleman Nee, who is the Chief of Forecasting. To Coleman's left, we have Barbara D'Andrea Adrian, Chief of International Trade Statistics. And to the extreme left, we have Marc Auboin, who is the Chief of Trade and Microfinance. We'll begin with brief remarks from the DG and Bob, and after that, we'll open the floor to questions. So with that, DG, over to you.
Can I have to leave? I won't be able to.
Yes, the DG will take 2 or 3 questions and leave because of other commitments, and Bob will continue with you. So, DG.
It's really Bob's show and the show of the team, So good afternoon, everyone, and thank you for joining us for the launch of our Global Trade Outlook and Statistics Report, which includes our latest trade projections. As you know, this year's GTOS arrives at a moment of profound economic uncertainty, characterized by regional conflict in the Middle East and rapid technological change driven by AI. The report also comes on the eve of our ministerial conference in Yaoundé, Cameroon, where we hope it will serve as a valuable reference for members as they work to achieve cooperative and mutually beneficial outcomes, whilst also protecting the most vulnerable. The report paints a picture of a global economy and a multilateral trading system facing serious challenges, but also demonstrating surprising resilience. Let me start by citing the headline figures. Under a baseline forecast scenario, world merchandise trade volume growth would slow from a stronger than expected 4.6% in 2025 to a modest 1.9% in 2026, before rebounding to 2.6% in 2027. Several factors contributed to the magnitude of the rise in 2025, including front-loading of imports in North America ahead of expected tariff hikes and surging AI-related investment. The one-time boost from front-loading is unlikely to be repeated this year, while AI-related investments is expected to ease, both of which would contribute to a slower trade growth in 2026. If sustained, however, the recent rise in energy prices linked to the Middle East conflict could shave another 0.5 percentage points of off-merchandise trade volume growth this year, lowering it from 1.9 to 1.4%. A similar pattern is expected in services trade, where a baseline forecast shows world commercial services trade volume growth slowing from 5.3% last year to 4.8% this year, before picking up to 5.1% next year. Although it's generally less volatile than merchandise trade, services trade would still be negatively impacted by a prolonged conflict in the Middle East, both directly through disruptions to transport and travel, and indirectly through slower GDP growth due to higher energy prices. Together, these effects would subtract 0.7 percentage points from our baseline forecast for services trade growth in 2026, reducing it from 4.8 to 4.1%. The Middle East conflict also threatens global food security, since shipping disruptions and higher energy costs reduce the supply and raise the cost of fertilizer. A prolonged interruption in supply could ripple through food systems, prompting farmers to reduce their use of fertilizers and plant less input-intensive crops. Under these circumstances, it's essential to keep global food trade channels open and predictable, allowing food supplies to flow to where they are most needed. Despite significant downside risks, the trade outlook is not without its bright spots. If the Middle East conflict is short-lived, and if the strong contribution from AI enabling goods trade is repeated in 2026, world merchandise trade volume growth could be 0.5 percentage points higher than in our baseline projection, raising it from 1.9 to 2.4%. WTO members can help cushion the impact of the conflict and ease the economic burden on people worldwide by maintaining predictable trade policies and strengthening supply chain resilience. Finally, let me close by noting that this year's GTOS also has an analytical chapter focused on the share of global trade that is subject to statutory MFN tariffs. Last year at this time, and taking account of trade actions through the end of 2024, we reported that this share stood at 80%, a remarkable reminder of the continuing importance of the rules-based system despite challenging times. This year, we have updated our calculations to show how the share of global merchandise trade subject to statutory MFN tariffs responded to tariff actions in 2025 and through the end of February 2026. This share rose and fell during this period, finally settling at 72% currently, which is a number that we've been using. So it's very interesting that, you know, with the ups and downs, we came back to 72%. For me, it's an interesting story going into MC14, and I'll be a two-handed economist as usual. It's interesting because on the one hand, as economists say, there has clearly been an erosion in the rules and they've been undermined. On the other hand, it's pretty remarkable that given the severe disruptions, nearly 3/4 of goods trade still crosses borders under MFN tariff terms. The lesson for us to take to Yaoundé from these numbers is that the rules-based system may be battered, you've heard me say this before, but not broken. It's far from broken. Finding our way to effective reforms of the rules in a way that can serve all members is a goal worthy of the efforts that will be needed to achieve it. Thank you. And I think my statement will be available.
Yeah, the statement will be made available to the press. Thank you, DJ. We'll have Bob.
Thank you, Ismaila. As Ismaila mentioned, I am the chief economist at the WTO, arriving in January and on leave from Dartmouth College. Thanks all for coming, and thanks to Dr. Ngozi for providing a succinct overview of the report. In my remarks, I will try to flesh out some of the details. I also want to take this opportunity to thank the principal authors of the report, Coleman Nee, Barbara DeAndrea Adrian, Mark Abuan, Ksenia Kolokskova, for delivering an outstanding report, as well as Thomas Verbit and Thomas Goncharz for contributing the special section on the MFN share. Many others worked as well tirelessly, and we appreciate your dedication. First, let me address the difficulty of forecasting in the face of yet another unexpected shock, which somehow these shocks all seem to arrive in the first quarter. The DG has already mentioned the different channels through which the conflict in the Middle East could impact global trade, not only through higher oil prices and slowing GDP growth, but also through reduced supplies and rising costs of fertilizer, threatening food security and vulnerable economies. As has been our practice in recent years, this year we present a baseline forecast that does not explicitly account for the Middle East conflict. But then we pair it with an adjusted forecast that does attempt to capture the full impact of the shock. If circumstances change dramatically, we could revisit our projections in the coming months. The report really features two headlines, but they are related. The first is that growth in merchandise world trade volume in 2025 came in at a surprisingly strong 4.6%. The second is that the forces that delivered this unusually strong growth are unlikely to persist through 2026. And in our baseline scenario, we forecast that 2026 growth in world merchandise trade will therefore fall to 1.9%. Of course, the big unknown is the impact of the conflict in the Middle East on our baseline forecasts. If elevated energy prices persist for the rest of the year, we expect that growth in world GDP would fall from our baseline prediction of 2.8% in 2026 to 2.5% before recovering in 2027. And we predict that this would shave half a percentage point off our baseline prediction for merchandise trade volume growth for 2026, dropping it to 1.4%. Growth would then rebound to 2.8% in 2027, since oil prices are assumed in our modeling to recede by then. A similar story holds for world commercial services trade volume, but with less variation in growth from year to year, because services trade volumes tend to be more stable than merchandise trade volumes. In our baseline scenario, we forecast that 2026 growth in world services trade will decline from its 5.3% pace in 2025 to 4.8% in 2026, before recovering to 5.1% in 2027. And if energy prices remain elevated for the rest of the year as a result of the conflict in the Middle East, we expect that growth in world services trade volume would fall to 4.1% in 2026, before recovering to 5.2% in 2027. One way to see how unusual the surge in global trade growth was in 2025 is to note that economists typically expect growth in global trade in goods and services to match or slightly exceed growth in GDP. But the numbers for 2025 indicate that global trade in goods and services grew at 4.7%, much faster than the 2.9% growth in global GDP in 2025. In fact, 1.6 times as fast. Our predictions for 2026 imply that the relationship between growth in global trade and growth in global GDP will fall back in line with recent historical trends. So what are the forces that delivered this unusually strong trade growth in 2025? This is where the forensic work that went into the report really shines. The first force is the front-loading of imports in North America that occurred early in 2025 in anticipation of tariff implementation by the United States in the second half of 2025. This resulted in a surge in North American imports in the early part of the year that helped to sustain the level of global trade volume for 2025. If you have the report in front of you and you turn to page 5 and look at chart 2, it gives a very clear visual of that front loading, with the first quarter of 2025 on the right-hand side figure is imports for various regions, and the North American imports rise dramatically for the first quarter of 2025 before falling back and then falling below for the later quarters of the year. That's the front loading that helped to keep imports volumes high in 2025, but that's a one-off force. The second force that delivered the unusually strong trade growth in 2025 was the investment boom in AI-related goods and services. Investment is typically the second largest component of GDP after consumption, and investment is usually more import-intensive than consumption. But a change in the composition of investment can alter its import content, with implications for global trade flows and their relationship to GDP. As we document in the report, investment in AI-related goods and services is unusually import-intensive, even for investment. For example, construction typically has a low intensity of imports, less than 2%. That means for $1 investment in construction, 2 cents would be from imports. By contrast, analysis of the import intensity of computer equipment and of recent AI investments indicates an import intensity of 70 to 90%. That means for $1 investment in AI-enabling goods, 70 cents to 90 cents would be spent on imports. So a shift in the composition of investment away from construction and other non-AI-related forms of investment toward AI-related goods and services will increase the level of imports for any given level of investment. And this is exactly how the AI investment boom in 2025 helped lift import growth above GDP growth, contributing almost half of the merchandise trade growth in 2025. And if you have the report in front of you and you turn to page 20, you will see a chart 12 that illustrates this very dramatically. The left-hand side of that chart breaks down the growth in the U.S. imports in 2025 by product category. The blue circles are positive growth and the orange circles are negative. falling imports, and the biggest blue circle is AI-enabling products. That's keeping the import growth in the U.S. high. And you'll see that the orange circles are negative. Those are the falling imports, but they all tend to be fairly close to zero, not that much fall. And the right-hand side shows the front loading that is keeping that happening. The right-hand side figure has by quarter what's going on with AI enabling. Those are the blue, and then everything else. And you see the big orange bar that is the front loading of products that were anticipated to have tariffs hit. And then in the first quarter and then the last 3 quarters, those are all negative. And it's that front loading that is masking the overall negative. So I think those 2 charts, 2 and 12, are really kind of exhibit A for the forensic work that went into our explanation for why we do not expect these forces to potentially continue into 2026. I should note that many of the AI-related products come from a relatively small number of countries. These include the United States, which is known for chips design, cloud infrastructure, and software. Chinese Taipei, which specializes in advanced chip manufacturing. The Republic of Korea, which manufactures memory chips and semiconductors. The Netherlands, which produces chip-making equipment. Japan, which makes precision manufacturing tools. And China, which specializes in hardware assembly, servers, and components. Consequently, North America, Europe, and Asia are the regions most directly impacted by the AI investment boom. In addition to the duration of the Middle East conflict, also unknown is how likely it is that the investment boom in AI-related goods and services will continue at the same rate through 2026. Our baseline forecast assumes that this investment continues strongly, but at a somewhat lower rate than in 2025. If this proves not to be the case, and if instead the AI investment boom continues through 2026 at the rate that it did in 2025, then up to 0.5 percentage point of additional world trade volume growth could be added to our baseline forecast. It's also important to point out that other regions are providing an important source of growth in world trade volumes for reasons not directly related to AI investment. For example, Africa's strong 2025 growth in merchandise trade volume is attributable to strong demand for fossil fuels and green transition minerals like copper, cobalt, and lithium, as well as to favorable conditions for crop production like cocoa and coffee. And the strong merchandise trade growth in the Middle East in 2025, Middle East region, was driven by a rebound in energy exports. Finally, as the Director General noted in her opening remarks, this year's report also has an analytical chapter focused on the share of global trade that is subject to the statutory MFN tariffs. This is not a comprehensive measure of the health of the rules-based system, but it provides one indicator that can be objectively measured. Last year at this time, and taken account of trade actions through the end of 2024, we reported that this share stood at 80%, a reminder of the continuing importance of the rules-based system despite challenging times. Our updated calculations in this year's report reflect the impact of tariff actions in 2025 and through the end of February 2026. As the Director General noted, this share rose and fell during this period, finally settling at 72% currently. The takeaway is the message that the Director General emphasized. The MFN share has declined substantially, reflecting an erosion of one of the core principles of the rules-based system. But nearly 3/4 of world merchandise trade still crosses borders under MFN tariffs. Or in the Director General's words, the rules-based system may be battered, but it is far from broken. Thank you, and I look forward to taking your questions.
Thank you, Bob. As I said, the DG has time for 2 questions, so we'll start with that. Christian.
Hold on, let me get
Thank you very much. I'm behind the sign. DG, do you have a message to those countries that have started the chaos in the Middle East by attacking Iran? What should happen to make sure that the impact on world trade is as limited as possible?
Well, obviously, we are an economic institution. So I just want to say that whenever there's conflict, in the world and the creation of uncertainty, it has a very difficult impact for business and for trade. So the best case scenario is if we could, if the conflict could stop. Thank you.
Thank you. Laurent?
Yeah, thank you, DG, for the briefing. So you said that you hope that the outlook will serve as a valuable reference for the member state. Now they have this figure of 0.5 point of percentage that might be the cost of the current war in the Middle East. So do you expect that war to be a spoiler or rather a wake-up call at the ministerial in a few days in the way the member states will behave? Thank you.
Well, even prior to the war, we needed to have a wake-up call because the world is changing so fast with technology, with geopolitics, that I think our members were recognizing that as far as multilateral trade and the institution is concerned, we really need to step up. I had said before, and I was quoted, the status quo is not an option. So I maintain that. So even before the war, but I think the difficult geopolitics we live in with conflicts in several parts of the world makes it even more so that we really need to be that island of stability. You've noticed that throughout all this unpredictability, the WTO rules have continued to serve for, as we said, almost 3/4 of goods trade. And this is analytically there, so anyone who wants to really look at the methodology and so on can see it. And that is because it provides the stability, the predictability that enables business to function. So I think members seeing that will have even more of a wake-up call to that we need to maintain this system, but not just actually that we need to improve on the system. And I think that's what we're there to try and achieve at MC14. Thank you.
Thank you. We'll thank the DG for her presence and move to the next questions online or in the room. So please, if you have a question, raise your hand and tell us what organization you are from. I see Antonio Boto online. Antonio, you have the floor.
Hello, good afternoon. I would like to ask about the effects of blocking the Strait of Hormuz, especially which regions and countries could be affected by this. And do you think that alternative routes can can be a palliation of this blocking? Thank you.
Thank you for your question. The basic economics of the income and trade patterns that would be affected by the blocking of the Strait of Hormuz tends to follow the export position or import position of the regions and countries when it comes to energy. Countries that are net energy importers will suffer from the rise in energy prices that is currently occurring, and those countries will have less income, and with less income will have less ability to import. Countries that are exporters of energy and are not affected by the disruption of supply possibilities will tend to, in economics terms, tend to benefit by having higher incomes, and through that higher imports. So there's definitely a variation in the economic impacts of energy price rises on countries and regions depending on whether they are net exporters or net importers. Importantly, this is not just about energy, it's about other things like fertilizer. And so for countries who are net importers of food or fertilizers, the blocking of the Strait of Hormuz, while it included shipments of 20% of the world's consumption of oil, it also included about 30% of the shipments of fertilizer, and so that is a big impact that is having a potentially big impact on food importers and food security of countries across the world. So those two effects are very much important for thinking about the economic aspects of the blocking of the Strait of Hormuz.
Thank you, Bob. At the back of the room.
Yes, thank you very much for taking my question. It's Maya Plants from The Brief. Some analysts say that if it weren't for the massive investments on AI infrastructure in the US, the country would be in a recession. Is that sustainable, do you see? And what does it mean for trade in the coming year?
Our expertise in our forecasting and here at the Secretariat focuses on trade impacts of various things, trade policy, but also macro aspects. And because of that, we tend to take consensus forecasts of GDP around the world and then adjust them to shocks like the oil shock. What we do not do typically is predict the overall macro impacts of shocks, whether countries and the world might go into a recession. So our report here does not address that issue. It looks at the expected impacts of oil shocks on the GDP of countries across the world based on the forces that I mentioned before, that net exporting countries who don't have the supply shocks are going to tend to have their income boosted. Net importing countries will have their income falling. And, but we're not looking at business cycle type implications.
Thank you, Bob. I have Brendan Murray, Bloomberg online. Brendan. He's muted.
Sorry. Can you hear me now? Hello?
Yes, we can hear you, Brendan.
Okay, great. Thanks. You went over 2025 and all the disruptions that U.S. tariffs caused, and the overlaying all of that was uncertainty. Companies didn't know what the tariff rates would be, what countries would be targeted. To what extent and now the administration has to shift gears and come up with some other kind of tariffs. To what extent, if at all, has uncertainty dissipated, or are we still dealing with that kind of a headwind for 2026?
In our forecasting work, the uncertainty from the 2025 tariffs is in a sense built into the structure, the economic structure going forward into 2026 that relates to movements in GMP or GDP over time and the movements in trade volumes that are observed over the years and over time. We feel that in 2026 there has not been a large aggregate tariff shock to the world. There was certainly movements in tariffs that were relatively dramatic with the U.S. Supreme Court decision on the IEEPA tariffs, but that was very quickly replaced by the U.S. Section 122 tariffs, and our work by our economists suggests that the overall macro aspect of those tariff replacements did not have much of a macro effect. Of course, there were effects on certain products and effects on certain countries in that change of tariffs, but they didn't have a large global effect. And for that reason, we're not doing changes in tariffs as an existing shock in 2026. So the uncertainty aspect of it is built in to the extent that it was there in 2025 and continues in the pattern that we see in the data. That is built into our forecast, but we aren't doing a new adjustment to uncertainty that might be arising because of 2026 actions.
Thank you, Bob. Christian?
Thank you for giving me the floor again. Could you tell us 1.9% 2026, that's low. When was it that low the last time round?
Yeah. So it has. We have data in the report that goes back to 2022, and in 2022, world merchandise trade growth was growing at 2.3%. Then in 2023, it was falling by 0.9%, and in 2024. Moving to 2.7%, and in 2025, then we had our 4.6%, and now we're predicting in 2026 1.9%. So the 1.9% is not as low as the lowest over the last 4 years, but it is relatively low, and that is reflecting the fact, as I mentioned, that in our 2026 forecast, we expect the relationship between the rate of growth in imports and the rate of growth in GDP to come back to more of its historical almost 1-to-1. And so the rate of growth of GDP is very close to 1.9 in our forecast in 2026.
Yes. So in 2020, I do have the figures here. In 2020, world merchandise trade grew, contracted by 5.3% during the pandemic, but also in 2023, as you can see on at the top of Table 1, merchandise trade contracted by nearly a percentage point, and this was in the aftermath of the war in Ukraine. And so this had, actually there were price increases in fuel prices, but there was an extremely large rise in natural gas prices in Europe that has not been replicated in the current situation.
Thank you, Coleman. Yes, here.
I have Angela from Senate Finance from China. So I have a question for Robert or Coleman. We have seen that you did some predictions about how this Middle East conflict is going to impact the global trade. But when we talk about the scenarios, they're always being positive scenarios, average or negative. So how positive you are when you calculating all the elements and, or let's put it that way, how positive your analysis is? Thank you.
Yeah, we report in this GTOS in detail one alternative scenario relative to our baseline, and that alternative scenario is, in a sense, a negative alternative, because it is the scenario that takes account of the impacts of Middle East conflict on energy prices, assuming that that conflict leads to elevated energy prices for the entire year. And the assumption that we make for that scenario is that oil prices would be at $90 per barrel, which was the price on March 10, the last data that we had before we finalized our report, and that prices of natural gas, liquefied natural gas, would be at $16 per million BTU. And that was also the price on March 10. And we assumed that those prices would stay at that level throughout 2026 and then return to more normal levels in 2027. So one could, if one were to look today, the most recent I saw just a few minutes ago was, I think the Brent crude was up to $116 per barrel, something like that. So one might say, well, maybe we undershot already, But what we would argue is on any given day, these prices are going to move. And that's not really what's important for us. What's important is what is the average price of oil, say, over the year of 2026. If it comes in around $90 a barrel, which would be the negative scenario where there was a lasting impact, but maybe not at 116 rather than at 90, then our forecast will be reasonable. If in fact the oil prices go up even higher and last for the year, then of course we're going to under predict the cost. And I should say that economists at the WTO have also done some robustness tests to see how our forecast would differ if instead of the time path that we assume for oil prices and gas prices, that they stayed at a constant rate for the whole year. If instead they spiked for a few months and then came down, and we feel that our forecasts are robust to that kind of variation. Where we would be undershooting things in our high energy scenario is if prices rose much more dramatically and stayed there. Then we wouldn't have the correct assumption, and that's where I mentioned that depending on how circumstances change, we could reevaluate our forecasts in the coming months to update them. But for now, we feel that we're comfortable with the assumption we've made.
Thank you, Bob. I have Caroline Fang online. Caroline.
Hello. Hi. Hi, thank you. I want to do I'm from Eastside Media Group from China. I want to do a follow-up question on tariff. I noted that you wrote in your report that this recent tariff developments have largely represented adjustments in approach rather than the fundamental shifts in policies. I wonder, would you be a little bit specific on this adjustment? Will this be much more severe than the previous measures? What I mean would be the large-scale Section 301 investigations that carried out by the United States. What impact will that have on the global trade in the coming years? Thank you.
Thank you for your question. Just set the stage, we all probably recall that the U.S. Supreme Court ruled against the use of IEEPA to support the reciprocal tariffs of the U.S. On a Friday, I believe, February 20, and then very soon thereafter, the U.S. imposed Section 122 balance of payments tariffs at a 10% across the board rate, mostly, and have announced that they may raise that to 15%. But so far, it has stayed at 10%. And then, as you rightly point out, the U.S. has been launching 301 investigations, which the Section 122 tariffs in the U.S. By law can only last for 150 days. They're temporary. So the Section 301s would presumably, if they lead to positive findings of unfair trade practices, that's against the U.S. That's what Section 301s in the U.S. law are all about. Then they could result in replaced tariffs for the Section 122 temporary tariffs. And whether those replaced tariffs are higher or lower than the 122s is, of course, not completely known. But it seems that the expectation is that the tariffs that will ultimately be put in place are likely to be similar to the tariffs that were there under IEEPA, and that is consistent with our basic assumption that the tariffs the tariff movements in 2026 are not likely to change dramatically the overall tariffs that countries face, of course, or that the world faces. Of course, as I mentioned, certain countries will be impacted differently, certain products will be impacted differently, but for our predictions about world trade and regional trade growth, we feel that, at least so far, there has not been compelling evidence that the tariff movements that are new to 2026 are really the story. The story to us seems to be the AI investment and the front loading that occurred in 2025, and that's what we're emphasizing in the report.
Thank you, Bob. I don't see any other hands online. Any questions in the room? No? No. So Antonio and Caroline, those are legacy hands, or do you want to ask new questions? Antonio?
Yes, yes. I have a new question.
I have...
Yes, I have a new question. It's according to the figures, the most affected region, both in terms of GDP and trade, in a high price of energy scenario is Europe. Can you elaborate more, or why this region can be more affected, even more than the Middle East, for example? Thank you.
Yes, thank you for your question. Yes, that's right. The EU the European region is highly affected under our high energy scenario. In our baseline forecast, the EU exports are predicted to grow in 2026 by 0.5 percentage point, recovering from some falling exports in 2025. And their imports are expected to grow by 1.3% in 2026, a little bit less than their imports in 2025. Under the high energy scenario, the European exports fall fairly substantially by minus 0.6% before recovering in 2027. And their import growth falls back to 0.3. So why is that happening? Why is Europe hit quite hard in the high energy price scenario? Basically because Europe is an important energy importer, and in particular liquefied natural gas, and those price rises are costing Europe as a net importer of energy more dramatically than other countries and other regions.
Thanks, Bob. Coleman, do you want to add something?
Yes. I just point out also that under the high oil price scenario, Europe has a large impact on its GDP, and European trade includes the European Union. In fact, it's the bulk of it, but it also includes intra-EU trade. And so if there is a slowdown in Europe, that will be magnified because of the counting of intra-EU trade in Europe.
Thank you. Any other questions in the room? No, I don't see any other hands online. So if there are no further questions, we'll wrap up here. Many thanks to Bob, Coleman, Barbara, Mark, and Thomas. And thank you to all for joining us today. And a special thanks to our interpreters. And just a final reminder, the embargo lifts at 3 p.m., meaning in 15 minutes. Thanks, everyone, for joining us.